in Kansas City and tell us a little bit about Park Place, and we'll go into some more details on how to use it and what you're seeing in the market currently.
Sure, John. Well, thank you so much for having me on your show. I really appreciate it. And it's always a pleasure to be on a show and be introduced to new markets such as Kansas City. As far as Park Place is concerned, Park Place, as you said, is a marketplace where syndicators and investors come together and make deals happen. It was born from the idea that, from my own personal experience as an investor, I've had pretty extensive investment history. I invested in single family homes and moved up to smaller multifamily homes, and then tried to get on bigger deals through syndications. And one of the gaps actually I saw in my own personal journey in real estate investment was the fact that I got introduced to syndications relatively late in my real estate experience cycle. And the fact is because most people actually don't know what syndications are, and most people think you have to invest in real estate through yourselves or maybe a couple of partners. And I just by chance got introduced to a syndicator, and I said, wow, this is pretty amazing that actually I could participate in these large being an investor in large buildings. And I mean, that was a kind of aha moment for me. And that's really, I kind of got into syndication, invested in several syndications. And still, even after that, I found out that, hey, there must be a lot of syndications out there, but I have no idea how to get a hold of them. I mean, unless you're kind of in the community of real estate syndications and professionals, you really don't really know much more than maybe a couple of syndicators within your own community that you got warmly introduced, got a warm handshake from friends and introductions. And then that took me to looking at crowdfunding sites, because at the end of the day, crowdfunding sites, all in all, are online platforms where syndicators come and list their deals. I mean, there's nothing more rocket science than that with crowdfunding. But even with crowdfunding, when I started investing in them, they still kind of limited the number of deals they had on their site. And I really didn't see a platform where it would be something almost like a LoopNet, where we would list the majority of syndicated deals out there for the benefit of the investors and for them to have the opportunity to look at all the different syndicators out there, their deals out there. And that's where Park Place was kind of the idea was initially, the seed of it was sown, and that's how Park Place was started. And our mission ultimately is become the MLS marketplace for syndicated deals across the United States.
And people are definitely familiar with the multiple listing service there. It's obviously the go-to for finding residential and commercial real estate, but not necessarily on the multifamily side. And it definitely has limited functionality, especially when you get to the syndication space. Give the crowd, because syndication being not necessarily like a higher level investing, but it does take some sophistication. What's your definition of syndication for the people that don't know, who are just used to buying their own real estate and managing it?
Sure. I mean, syndications in a basic level is a partnership of a group of individuals that come together to collectively invest in an opportunity, in a property that otherwise individually they wouldn't have the opportunity to invest in. So and within that partnership, the structure is typically, there's a limited partner side and there's a general partner side. The limited partners are individuals such as I have been, that are professionals. They make money, but honestly, they don't have the know-how to find the right deals, or they don't have the capital to invest in these larger properties, and they don't really want to manage these properties or being able to extract value out of them. So they want to participate in kind of these large properties, but they don't know the way to do it. And that's the limited partner side. And the general partner sides are actual the syndicators, or otherwise called sponsors, operators. They're all the same thing. They are really the kind of the seasoned professionals that have done this. They put the deal together. They have the connections to find the right deals, to manage the deals, to add value to it, and then ultimately, sell it, or and bring profits back to distribute profits to themselves and their limited partners. And that's really the basics of syndication. As easy as that. It's not very sophisticated in a basic level. Now, there's a lot of nuances to it, but that's the basic term for syndication.
Right. Yeah. No, thanks for giving that definition out. We're obviously in the syndication space every day. I do GP and LP investing all the time. You can't manage your own stuff and scale. So I'm all for syndicating other people's, I'm all for passive investing in other people's deal, because it's just like, you only have so many hours in the day, and you only have so many resources. So as what you're saying, as far as sophistication, you can obviously get in deeper into it. You have to understand the business strategy they're taking throughout the years, and their pro forma, making sure those numbers work for your risk appetite. When I was looking through your website a bit ago, parkplaceinvestment.com, you guys do have a real estate investor's guide to syndication. So I thought that was a pretty awesome PDF. You guys can go ahead and check that website now. You can download it. It's a free guide, and it goes through and tells you, hey, this is what a general syndication looks like, and this is what you may want to look at as far as knowing what to invest in. So I think that'd be a great guide for sure. So tell us, so it looks like it's for both parties. Run through the process on how this would work. I don't know, you could start on the investor side or the syndicator side.
Well, let's look at the investor side. We were talking kind of about the investor. So from an investor side, you would, much like the structure for example, Redfin or LoopNet is, you go on the site, you may or may not have a particular area you're interested in investing. You may have a certain asset class that you're interested in investing. Let's say you want to do multifamily, and let's say you have a certain metrics you're looking for. Let's say you want to have an internal rate of return of 16 and above. Well, you could plug those metrics in, and being able to find all the deals across the United States where meets those criteria. And then then you could go through each detail, look at the deal. There's photos of each deal. There's the name of the sponsor, event. There's a documentation associated with that syndication. There's details that's put on by the sponsor about the deal, the structure of the deal. And there's videos, if they produce videos. And we usually produce a 20-minute video that the sponsor makes with us to just explain their deal. And if that's the particular deal is something you want to invest in, you contact the sponsor directly, and you get your questions answered more directly through the sponsor. And ultimately, it becomes a one-on-one interaction, a relationship between you and the sponsor. And you may or may not decide to invest in that opportunity after all the discussions. But if you happen to do, then the sponsor could go ahead and sign you up for the deal. And that's really it's a pretty basic steps to go through. No magic about it. However, the magic is when there's hundreds of deals on the side, you have many opportunities above and beyond the people the syndicators you have already had relationship with, to be able to invest in and learn more about it. On the other side of it, we're trying to really educate investors, and that's really important because, as I mentioned earlier, the basic concept of syndication is easy, but then there's a lot of legal terms, financial metrics that you have to understand. For example, what is an equity multiple? What's an IRR? What's the difference between how do you get paid? How does a sponsor get paid? And these are all valid questions that investors should ask when they invest in a deal. I don't recommend blindly ever investing in a deal because you could get really hurt if one deal goes sour, and if you don't have a good understanding of the structure, then you may get hurt once and never want to come back and invest. And that's something we really don't want, because one bad experience shouldn't be kind of a rubric for how you judge other investments.
Makes sense. Yeah, I mean, it looks like definitely the investor could take a look at multiple deals, get a feeling of what's on the market. Looks like you have an opportunity to all across the United States to get in various deals. It could be anything. Looks like from multifamily to retail. Is that correct?
Yeah, so we have we have both. So yeah, we have some retails, we have multifamily, majority are multifamily. We have a debt fund, a bridge loan debt fund. So we have the various different types of deals, and it's important to know that when we talk about syndication deals, they could be a one-off deal, which is one asset or one property. It could be a fund where the sponsor invests across several different properties, and it could also be a debt, like it could be a loan that like for example a bridge loan fund. And so that's also important for investors to know, that there's different types of syndicated deals, quote unquote, that they could invest in.
So right now, as everyone's been experiencing, it's been a tough year. Obviously, deals have been done, not necessarily going as planned, but people are still have to make a living. What have you seen lately as far as the general market? Have you seen a trends in certain type of asset come to this online marketplace? Maybe are you seeing certain return metrics that are updated? What are you seeing right now in this pandemic type environment?
Sure. I mean, there's a few trends. One trend is migration of individuals or people away from primary markets, such as the coastal markets, be it New York City, Los Angeles, Washington, even Washington, D.C. area, to more areas that are, really cost of living is cheaper, purchasing a home is cheaper. So we've definitely seen that. And I think most of your audience probably knows about that, we've seen, if you look at for example, the U-Haul trends, and they're moving away from West Coast, from Northeast into more Southeast and Southern areas of the United States. And that's understandable, because when you could work from home economy is taking hold, you really don't have to live in an expensive area to be able to provide the service and the work that you need to do. So that's the first trend we're really seeing, and that's why a lot of markets our secondary markets and tertiary markets are heating up, and also there's cheap capital out there. I mean, the rates for loans are all-time low, so those markets are definitely heating up. As far as the type of commercial asset class that really has been doing really well, number one is industrial, because of again, it's tied into work from home economy, from Amazon economy, that retailers are going more and more online, and that's really been the largest year-over-year growth in commercial real estate. Number two is multifamily. So those are the top two that really have seen positive growth. Obviously, the one that got hit the worst is hotels and hospitality, which I think was negative 16% down, and the second one is retail. And those have been, retail has been really a trend that's been going on for years now. Obviously, hotel and hospitality has been it's kind of more tied into what's going on with COVID.
Are you seeing probably general overall cash on cash numbers and IRRs trend down a little bit? Like, for example, I've been seeing around 7 to 9%, low teens to mid teens.
For which one? For cash on cash or?
Sorry, for like multifamily apartment holdings, 5-year holds, maybe a refi in there. Yeah. Are you seeing numbers in that range?
Absolutely. I think they're always, I mean, and that's a good thing, right? I mean, you have to, if an operator or sponsor doesn't really communicate with their investors about, hey, listen, this is a tough time and we need to readjust and hold more reserves or readjust our rent growth if it's for multifamily. And that's actually something as an investor, the sponsors that I've come in as an LP have communicated with me. And that's actually a good thing because, everybody knows that, this is crazy times, right? I mean, it's unprecedented times. So it's good to have that communication channel open and come down on your estimates. Now, none of the deals have gone full cycle, so you don't know whether those target downgrades are going to really hold true or they're going to be upgraded in a year or so. So I can't tell you whether, I mean, for sure, I mean, the sponsors have downgraded their targets, but at the end of the day, if the economy comes back up, I mean, they may overperform of what they were estimating. So,
interesting. Is there, you said, so the most popular multifamily is second most popular, you're saying, on the platform right now?
No, multifamily is the most popular. Okay. I'm talking about, I mean, as far as in general, the asset class that's performed the best is industrial.
Gotcha.
But yeah, obviously those are bigger. Those are, on our platform is mostly geared towards multifamily because that's most syndications really, I mean, geared towards multifamily currently.
Are you seeing, you talking about the trends and everything like that? That's always interesting stuff. Are you seeing anything in particular on these multifamily deals that the investors are investing into versus another deal? For example, like tips for if other syndicators need to raise capital and they want to post on the platform, are you seeing something that's going to push investors towards their deals versus others?
Oh, I see what you're saying. Well,
or is it only just returns? I don't know. Probably more being.
Yeah, I mean, honestly, I think I mean, if an investor only looks at numbers and invest, I think there's a problem because you can't just you can't just look at the numbers, the target numbers, but those are estimates, and I really don't recommend any investor just looking at, like, for example, 2 deals with 2 different IRRs and invest in the higher IRR. That doesn't make, I mean, that's very it's a very bad form of investing. I mean, IRRs could be very manipulated, as you know, based on when you're distributing when the distributions are made. So it really, I mean, that's first of all. As far as the multifamily, I definitely, as we talked about the secondary markets and on markets such as the Carolinas, Tennessee, Florida is a hot market. Texas, Dallas, Fort Worth, as you mentioned, is a very hot market. Indianapolis is another market that's booming. And it's really a shift towards Midwest and Southern United States. So investors are more are looking at those types of markets. And ultimately, it depends on the investors. I mean, still, the trend is to invest more locally to where the areas you know about. So that we've seen that also. I don't know whether that answered completely your question or not, but
yeah, no, that gives me a good idea. You obviously have a good insight of what's coming to market. It's almost kind of like having a broker's view, because you're saying, hey, I'm seeing a lot more retail, industrial, multifamily, mobile home parks come on. That's definitely an interesting view.
One more thing I want to add is actually I think in these times, a lot of times, a lot of the syndications are going toward a fund model because as you know, when you are trying to raise funds through a one-off deal, you only have a certain window of time, right? 60 days average, maybe 90 days. You could push it a little bit longer to extend your contract, but at the end of the day, there's a time crunch. When you go towards the fund model, is well, that's a kind of an evergreen, like it's always open. So you have a little bit more time to gather the capital and invest more in a series of deals and kind of diversify your portfolio for the investors' benefit. So if one deal is not doing well, it will make up for another deal with higher returns will make up. So it will average out to a better return. So that's something we certainly have seen. The funds are blossoming more and more.
Okay. As far as syndicators joining the platform, you mentioned the process, fairly straightforward. It looks like you also have like a management portal side for the investors for the deals they invest in. Is that correct?
Not right now. Eventually, we are thinking about it because, and the reason is this: is to have an investment management portal, is because if you think about it, let's say for a sponsor or syndicate, it's always easier to raise a large sum of money from one or two people, right? Because there's a lot of behind the scene work that needs to be done, right? Distributions, reporting, taxes. So when you get into kind of quote unquote crowdfunding, where you have to, and some crowdfunding sites, not ours, but could go down to as low as investing $500 per per investment. So if you think about it, if you want to raise, let's say minimum like let's say 500,000, which is a small amount, but $500 each, you're talking about 1,000 investors, right?
Right.
So the traditional models of doing everything by hand or things, it's really difficult. And a lot of the platforms that allow for the smaller sums to be raised, you really have to have a robust management software and a CRM to be able to handle these larger number of investors that are you're going to be responsible for. So I mean, that's part of the plan of creating that if there is a need right now, because we're looking for kind of a larger minimums like 25 to 50K. It's not as much of a deal, but eventually I think we do need to go that route and create investment management software on top of kind of like a software as a service on top of our portal.
Sure.
We're working on already, but as of now, we don't have that built.
Actually, now that I look at it, this side is probably more for the syndication side for like my deals in progress and stuff like that. Right. Yeah, that was my mistake. And it makes more sense. Obviously, this is a platform for syndicators. The investor side, it's just merely a portal to connect you to them. The syndicators are going to be doing the management of the deal process. They might have their own platform like Syndication Pro that they'll log in and check out the view. So
exactly. And that's a great platform.
I just didn't want to. I just wanted to make sure because those are clearly two different paths for a platform.
Yes.
So that makes sense. As far as the market going forward, what do you see out there for multifamily? I know, this year might be tough. What do you think as far as, the government stimulus? Obviously there's been some double digit vacancies for areas that are maybe lower income or on the coast. Are you seeing anything from your platform and just the general talks of other syndicators of what they're going to see in the future or in the short term, at least?
Sure. I mean, I think you hit the nail on the head. Is again, if you look at the average, when the syndicators talk about the vacancy rates, first of all, on average, the vacancy rate has been really, it's asymmetrical as far as with the areas that have been hit the hardest. And you're right, like San Francisco has doubled, San Jose area have had really, I mean, I'm talking about as you said, 15-20% vacancy rates now. New York, same thing. But then you look at markets in the Midwest, or even, for example, you take Boise, which I was looking at the numbers today, they've had 7 or 8% year-over-year increase in rent. So it's very asymmetrical, and that's because of the migration patterns that we were talking about, is the fact that the really primary markets, people are realizing, well, this is way too expensive for me to live, and they're not really shackled by the geography of their workspace anymore, right? I mean, in Silicon Valley now, Google for the next 2 years says you could work from home.
Oh, wow.
And I think that's kind of where technology has come about, to a point that, you know, you could create that productivity from home now. Because I know that was a huge problem. A lot of companies tried it before, but they found out that productivity wasn't as good. But now technology has reached a tipping point that actually companies are finding out people are as productive now. As far as, you know, some of the issues with working from home, like, you know, recruiting, training, you know, that corporate culture, well, those are things that are work in progress, and those are things that are still done better from being actually present at the corporate office, and that's the point of optimism for people that advocate that these primary markets, such as New York, well, New York is a little bit different, but let's say Silicon Valley is going to come back, because actually eventually companies are going to realize that, you know, we can't do everything from remotely, and we do need maybe a hybrid model almost. Some people working remotely, some not. Maybe half your time you'll be coming to office, the other half you won't. And that was already kind of the trend that was happening. The interesting thing is now, you know, the trend of remote work, going to areas that you never thought about, like medicine, right? I mean, you know, you're doing telephone visits or video visits, you know, things that you never thought was imaginable, that you could see your doctor without even, you know, touching them or shaking their hand. That's what's happening. So it'll be interesting to see how the medical office space would be in the future.
Yeah, I mean, if there's usually good things that can come out of every situation, and this one is obviously definitely more time spent with family.
Exactly.
And then, what's that?
One more thing, I was going to talk to you about the multifamily trend, because I know you mentioned that.
Yeah.
I was involved with one of the sponsors, and this is a ground up multifamily that they're doing, and in their pro forma and their PPM, they mentioned that since COVID has happened, they're increasing the the unit sizes to take into account individual bathrooms, for example, something like that, right? You know, so you could have, you know, something like that. So the footprint of each unit will be larger. For example, that's something. For example, kind of a high-tech filtration system for HVAC is going to be something that's going to be for office spaces that you can't open the windows, right? That's a trend that's been happening. For example, increasing in your open spaces outside your apartment complexes, because if people are working from home, well, they're gonna get tired, right? They want to walk outside. So increasing the green space and open space on the outside, or the common spaces outside. Obviously, high-speed internet service. And those things are definitely the trends that are going to be seen in multifamily more and more, especially in competitive markets, that you need to have a strategy to add value.
Yeah, no, that's good advice, because like I said, you're getting a perspective for each deal that's coming through. I think other syndicators and just real estate owners in general should take notice and think, hey, if you look on the platform and you could see other deals being funded for other, take a look, get tips. Yeah, it could be, I'm sure it's a business plan or returns, but possibly trends towards pandemic proof type lives in the future. So that definitely makes
That's right.
sense. And
That's right. I mean, you know, COVID is not something, in my opinion, it's not going to go away with COVID itself. It's going to be a COVID mentality of that's going to be hard to get rid of, and it may take decades to get rid of that. I mean, so I think there's short-term implication, there's a long-term trends that it's going to accelerate and create, and these are some of the trends that are going to be going on. Um,
Yeah, I mean that's true, and we'll see what comes out of it for sure. Things have changed. Obviously, we'll go back, I'm sure, to the office, but maybe not entirely. Um, Appreciate the information. Let me hit on one last thing before we wrap it up. What obviously credit investors are probably looking at these deals because they're being advertised, the 506 type C. Are you there's been some stuff out from the SEC that says, hey, with some tests, and we're going to put out some other rules. There's going to be some loosening regs on how people can invest in these deals, and cap raisers are going to be able to be compensated. Is there anything that you see trending towards at least allowing an average investor, without necessarily being credited, to invest in these deals and use this platform more?
Sure. So number one is you hit the nail on the head. It's 506C is one type of exemption you could get to do general solicitation, or it's just a fancy term for advertising your deal to the investors that you don't have an existing relationship with. There's already been loosening of some of that. It's going more away. I mean, it's not away, but a credit investor was typically defined as either you have to be net worth of $1 million or more, not including your primary residence, or for single individuals, 200K, for married couple, 300K to be able to be an accredited investor. Recently, over the last few months, at the end of last year, they opened that up to individuals in the financial industry with certain licenses, like Series 6 or 7, or things like that. So those are, the trend is towards loosening up of the restrictions, away from just a purely based on your income or net worth to kind of a broader blanket or net of individuals. And I think that's going to be an ongoing trend. Number two is, as far as non-accredited investors are concerned, I'm sure you guys, you've heard about crowdfunding as crowdfunding exemption, which is a different part of the, it's a Title III as opposed to Regulation D, where it allows for sponsors to raise money. The issue with that was, as far as real estate is concerned, was the cap was at 1 million. It's like 1.07 million, which was a really kind of a small bar, because you can't, I mean, for investment, for big like apartment complexes, for real estate, that was really a minimal. I mean, you can't really, that's not enough to raise for such deals. But SEC actually raised that to 5 million. So that's a big deal. And with Regulation CF, you could go to non-accredited investors. So that's the big deal. So I think that's going to be playing a bigger and bigger part. As far as how non-accredited investors could participate, obviously, if they have a pre-existing relationship with a sponsor, and the sponsor has a 506B, there's a limit for 35 investors they could get on board that are non-accredited. And the other regulations, Regulation A, which most sponsors don't have, because that's a huge deal to get. It takes months and a lot of money to get. But if you have a Reg A or A plus, they call it, then you could go to non-accredited investors. And some crowdfunding sites have a Reg A, and they could present their deals to non-accredited investors. So those are how non-accredited investors could get on some of these deals.
No, that makes sense, and appreciate it, providing some insight there. That the regs can get kind of confusing. I always tell people definitely Google the regs, but usually if you're seeing advertised, it'll be the C. So yeah, sounds good. I encourage people definitely check out the website. Go ahead and give people your contact info. I know you got, some LinkedIn,
Sure.
Facebook, website, email, for them to get some more information on how to list and for investors to check out the current deals that are on market now.
Sure, John. Thank you. So the website is parkplaceinvestment.com. If you want to email me, it's info@parkplaceinvestment.com. We're on LinkedIn and Facebook, Parkplace Investment. We could find us there. It's the logo is a little red house. That's how to find us. So those are and I really appreciate you giving me the opportunity to be on the show. I really appreciate it.
No, thank you. I had an adjustment in our time, so it was definitely my fault. I encourage people, obviously look into the LinkedIn profile. Definitely check out the website. If you look on Facebook there, you have past interviews. You're obviously trying to stay active. You're a real estate investor. You're trying to gain the knowledge so you could build your platform better. Offer advice to real estate investors on, hey, this is what I think would be a good investment. And then also offering the platform and advice to syndicators on, if you want to sell this deal, this is what's getting the funding. So, I mean, it's going to be additional things other than you investors or syndicators blindly just posting it. So
Yeah.
you're seeing real-time feedback from the market and reaction to those listings. So I think that's a valuable additional service, when you attach to a platform like yours. So, I mean, being a syndicator myself, this is great because it's another tool. I already know how difficult it is to raise your own money. You have to make a million calls. You got to hope they have the money at that time. And especially, just not being able to advertise, just having the ability to have this platform, it could definitely be a benefit to go the C route, just because you have access for your marketing tools. I'm sure you do email blasts out for these clients and say, hey, here's the syndication deals currently on the market. These are all things that could save a deal for sure. And then just to add it on, the less GPs you need or capital raisers in your deal, technically, that's going to help your equity split yourself versus bringing on, 50 capital raisers just to close a deal. And obviously that's not going to leave much meat on the bone. So it might not incentivize this syndicator themselves. So I could definitely see a lot of benefits of using a marketplace like every other marketplace out there. So
Exactly.
appreciate you building this platform, and I'm sure it's going to get better too, for sure.
Definitely. There's a lot of work. We're always nimble. We're improving the platform. Our just a preview of coming in the next month or so. We're going to basically create a directory with sponsors out there too, for the benefit of investors. So not only that we're going to bring in the deals that we have on our platform that the certain sponsors have wanted to be on the platform, but at the same time creating a directory for the benefit of investors, right? So you as a sponsor may not have a deal, but you want to be out there on our map or on our directory. So if an investor is interested, could hear more about you directly. So those are the things that we're always looking at what an investor would like and trying to improve on it, because at the end of the day, investors make everything happen, right? We wouldn't be in business if we don't have investors. So the more we add value to investors, I think the more successful we'll be, both for ourselves and our sponsors. So.
Yeah, no, I could really see it. And I know you do a lot of video now. I could definitely see in the future if you guys, you guys might be doing it now, just having YouTube videos about, some of the new deals coming on and talking a little bit about them. But I'm definitely on board because we're passive investors ourselves. The syndication route, especially nowadays, using the leverage of other minds, other deals, and other people's money to invest with you. It's really attractive right now because things are so competitive. Life gets so competitive. Um, the returns are just as good or easily better than looking into your own real estate and starting off small, because this is unfortunately a lot of new real estate investors are late to the game. So to leverage all these years of experience, have the availability of such a large diversity of a marketplace to shop around for the best return for your money, I mean, I I encourage people to really take a look at that, because you'll be able to be much farther scaling like this versus, like I said, picking up a paintbrush and doing one house at a time. And we all know the pain there for sure.
Oh, for sure. I agree with you completely. You said it really well. Couldn't have said it better myself. Did it
No,
very,
thanks again for
of
joining us.
course, my pleasure.
We'll definitely, we like to connect people in the future, see how things going. You'll have that much of a better of a market update after you see things roll through this year. So thank you for your time. We'll have this posted in a few weeks, and just to mention out there for people, check out marei.org. You can become members just for single persons or business. There's a business membership too. Kim Tucker is always doing an amazing job. Check out marei.org on Facebook, and then of course Kam's platform. So we will catch you guys on the next one. Thank you again. Sorry I was late to this interview, and we'll catch up with you in the future, and we'll appreciate it. Thanks, Kam.
Thank you so much.
Have a good weekend.
Yep. Hey, have a great weekend, man. Thank you so much. Okay, talk to you later.
Bye.
See you later. Bye-bye.